Hello, and thank you for joining us today for this webinar presented by ARTA's Pension and Financial Wellness Committee. We're pleased to offer a series of financial wellness seminars throughout the year to create an opportunity for education on topics specific to retiree financial wellness. Since ARTA was formed in 1963, we focused on supporting our members in an engaged and active lifestyle in retirement. Our holistic approach includes one of the best benefit plans in the country, as well as many additional programs and services, including our ARTA Perks discount program, physical wellness events, social opportunities offered through our regional branches, scholarships for family members, and of course, seminars just like this one. ARTA also serves as an advocate for teachers and retirees using our collective voice to draw attention to the ATRF and teachers' pensions and the impacts being felt in healthcare. There are many different factors that allow ARTA to maintain such a wide reach. But in the end, because we were created by retired teachers, for retired teachers and like-minded professionals, we remain dedicated to retirees. With that, I'll pass things off to the chair of ARTA's Pension and Financial Wellness Committee, Larry Hartel.
Thank you, Scott. My name is Larry Hartel, and I'm the chair of ARTA's Pension and Financial Wellness Committee. I am joined today by Pension and Financial Wellness Committee members and by ARTA's Vice President, Mary McDougall, and ARTA's Treasurer, Alain Levesque. A couple of housekeeping items before we start. As you may have noticed, we have disabled the attendee video and audio capabilities. This will help to ensure the quality experience for all participants by limiting web streaming and will allow us to record the webinar without breaching your privacy. With your audio muted, we encourage you to use the Q&A feature at the bottom of your screen to submit questions. You can submit your questions publicly so that all attendees can see them, or you can submit them privately so that only the ARTA staff will be able to see them. Our team and the speakers will respond to your questions at the end of the webinar. A reminder for participants that this presentation is for informational purposes only and should not be used to replace a consultation with a trained legal, tax, or financial professional. Please contact a professional for financial, tax, and legal advice related to your specific circumstances. With that, and those housekeeping matters completed, ARTA is now pleased to present today's session, an informative presentation of ATRF's 2025 annual report. This webinar will be of interest to retired teachers as it pertains to the health and longevity of the pensions for teachers in Alberta. I would like to welcome today's speakers, Rod Matheson, Joelle from Alberta Teachers Retirement Fund, ATRF. Thank you.
Thank you, Larry. Thank you, Scott, for this opportunity. So I'm, as Larry said, Rod Matheson, and I'm the CEO at ATRF, and my colleague Julie Joelle is the VP of Pension Services. And Julie and I both always welcome the opportunity to interact with our members. I mean, you are our raison d'etre, right, Julie? And I would also add, we do very much value our relationship with ARTA. We view ARTA as a key stakeholder for ATRF. Daniel Malloy and I get together, Scott and the team get together with our team on a regular basis, looking for opportunities to collaborate. Our membership base is a common membership base, and so I think we have a very good relationship and appreciate the work that we do together with ARTA. So today, I'm very pleased, or Julie and I will be very pleased to share a presentation which provides the highlights of our past year in terms of the actuarial results, the investment results, our member services that we provide. And I'm also very pleased to say this is hot off the presses. You are getting this information almost real time because it's just live on our website today. So you are getting the very latest information about ATRF and our pension plan and our organization. So with that, Julie, let's go to the next slide. I will speak to a couple of slides and then I'll hand it over to Julie to cover some of the results for last year. But I like to start with a couple of slides that are designed to provide some context, especially if you're relatively new to our presentations or our organization. There's some important background that's always helpful. So this slide on the left side, it talks about us, ATRF. We are the pension plan administrator. Administrator means we're the ones that are paying the benefits to all of our retired members. Our board sets the contribution rates, and we collect all the contributions that come in and manage all of the payments, the inflows in and out. The board at ATRF plays a very important role in ensuring that the plan is appropriately funded for the long term and setting the appropriate funding policies and setting the investment policy and then related oversight of our investment manager. I'll speak to that in just in a moment. And then, of course, delivering the high quality member services that we pride ourselves on for all of our members. That's what we do. On the right side of the chart is the plan sponsors, the Alberta government and the Alberta Teachers Association. We would call the sponsors of the plan. And what the sponsors are responsible for is designing the plan. They set the plan rules. Those rules are set in legislation. Those rules include all of the plan's benefits. So we often get questions from members relating to features of the pension plan or some of the plan rules. And I just want to pause here to say the conversations about plan rules or the ability to change the plan rules rests with those two sponsors, the ATA and the Alberta government. And then the final bullet is the sponsors are the bodies, the two bodies, the ATA and the government, that appoint the 8 members to the ATRF board. And just quickly, that slider across the bottom there, the consultation and collaboration, what I also like to stress is we at ATRF are the experts when it comes to the teacher's pension plan. And we want all of our stakeholders, both our sponsors and our friends at ARTA and others to recognize that we do know the teacher's pension plan and we want to be viewed as a trusted advisor. If either of our sponsors, if ARTA, if others have questions about the pension plan, please come to us. We want to be viewed and work very hard to be viewed as trusted advisors to those key stakeholders. And then the second slide is one that also addresses questions we often get, and that is, since the legislation was passed a number of years ago that require us to use AIMCO, Alberta Investment Management Corporation, as the investment manager, we get questions around, well, what does that mean and what are the respective roles and responsibilities? So on the left side, ATRF's role is still very critical. In fact, the most important role, because what we're still responsible for is setting the investment policies and the strategic asset allocations that will drive long-term success for the pension plan. That's our focus. There's a lot of finance literature that says in the fullness of time, the long-term sustainability of a pension plan very much depends on getting that right. 90% of the long-term success is based on establishing the appropriate asset allocation between all of the asset classes and making sure that you're looking at that through the lens of being a pension plan. And then the investment manager, in our case now, AIMCO, their role is to take that asset allocation and that investment policy that we deliver to them and implement it and choose within the asset classes the appropriate investments, manage the investments within that portfolio. And that finance literature would say will generate an additional sort of 10% to the long-term value or the long-term sustainability of the pension plan. So ATRF still is the driver and the key player in long-term investment success. I'll stop there for now, and I'll turn it over to Julie, who can now actually start talking about our results for last year.
Thank you, Rod. So speaking of good results and strong financial health, this slide, drum roll, is showing that again, we are fully funded on the teacher's pension plan for the third year in a row. We crossed that milestone 3 years ago. And it's such a great news for even this group in particular. That shows that the plan is fully funded. There's enough assets to pay the pension obligation, pay what we're supposed to pay for all of you for your lifetime. Of course, things can change. I'm an actuary, so I will always have to put a disclaimer. Then these are based on assumptions, these are based on projections. Things can change, but I will talk about what we do to make sure that the plan is resilient, that can face those unknowns. And at this point, we are in a very, very good shape. So the teacher's pension plan, that's the green line, it's 102% funded. And the blue line is the independent school teachers pension plan is 112. Just a quick note, what is independent school teachers pension plan? In previous presentation, you would have heard the word private school. But as you might know, the government of Alberta made a change to change the name from private school to independent school. So that's why the plan is now named independent school. It's a much smaller plan, but it's still very important. And as a teacher, as a retired teacher, your service, if you have service in both, it's combined, it's very seamless. You receive one pension from both plans. So really it's one plan, but from funding, it's two. So what is a funded ratio? I keep talking about numbers, 102%. What does that mean? It's a ratio of the assets, so the money in the plan, compared to the liabilities, so the obligations, what we're supposed to pay out of the plan. So the ratio of that, so that means we have uh, a little bit more assets than the obligation. That means there's a little bit of surplus, which is a good thing to have. It's like your own savings. You don't want to be so tight that you cannot absorb any changes. But in this case, we have a little bit more assets than what is being payable from what is being supposed to be and expected to be paid on a benefit side. Those are all the pensions and other benefits we're paying. So, and we're showing, of course, a little bit of a trend, the historical value of that funded ratio. And as I mentioned before, we became fully funded 3 years ago. And if you look at 2015, we were 80% funded, 82% funded. And that meant, we had to put a bit more money in the plan to make sure that we could cover that variance, that deficit. But it's done. It's paid, and we're in good shape. So very strong financial position, and even more strong because we have in place levers for risk management. And like I said, it's based on assumption and projection. So you need to make sure that there is some levers in place in case things don't go as expected, that investments maybe are not producing what we thought they would. So we have three main levers, and I'm going to explain very, very quickly. It's a bit technical, but we have margins. Think of that as a kind of a buffer, a cushion. We have asset smoothing so that we don't have to recognize right away if there is a big loss or a big gain. If we think it's temporary, we won't recognize it. We'll get 5 years to do so. And of course, surplus, which is a new thing for us. It's good to have a little bit of surplus, like I said, so that you're not so tight. And when things happen, you have to ask for more money. Those levers are very strong risk management tools. They are very common in terms of pension plans out there, defined benefit pension plans, industry practice, and best practice in terms of funding. They allow us to meet our funding objectives, and they're even more important in a plan like ours, where it's a lifetime pension, also guaranteed for some level of indexation. And that requires a lot of risk management because things can change when it comes to inflation. We've seen that in the recent years, right? We saw much higher inflation than what we would have normally see, but the plan was able to pay for that because we had those margins and levers in place to absorb that unexpected high inflation. And a lifetime pension, it's a great feature of a defined benefit, but that is also relies on life expectancy. So if people are living longer, which is great, then we need to be able to pay for longer. So we need more money for that. Speaking of assumptions and methodology, I've put that slide. I'm a bit of a geek in terms of numbers, but for two reasons, just so that you know what comes into the calculation of the plan funding and the plan obligation. So it's based on assumption for returns, for inflation, for demographic assumptions such as mortality, salary increase. So every year, the board and ATRF management are looking at, is there a need to refresh the assumption to reflect what's happening out there in the economy and long-term expectations? Because that's the thing, we also have to look long-term. So assumptions not necessarily going to change every time there's a bit of a blip in the market. We need to look long-term of what is expected. What's a little bit more short-term, and you'll see it here, is salary increase, for example. If we know that there's a known number for salary increase, we take that into consideration right away. And that's why I'm pointing it here. It's because, of course, this year is very unique with the legislated agreement in terms of Bill 2. And yeah, as a retiring member, you might say, oh, it doesn't really apply to me. But I'm mentioning it just in case we have newly retired member in the audience, that if you recently retired in the last year or so, and you had a teaching contract in September of 2024 or during the school year of 24-25, there were retroactive salary increase, which might generate a recalculation of your pension. So if you are part of those in this group, don't worry. We'll be in touch with you once all the data is coming through, and you'll see potentially an adjustment to your pension. But just remember, you have to be under teaching contract in the 24-25 school year, and then retired from them. So maybe we don't have anyone, I just don't know who's in the audience, but I thought you might be interested to see that Bill 2, the legislated agreement with salary increase retroactive to September 24, we had to take that in consideration for funding. And we have to take that in consideration for calculation of benefits, recalculation, and of course, communication going forward of the salary that's applicable. Just that's a lot of numbers, but this is our balance sheet in terms of the pension plan. Just wanted to show that, as of August 31st, 2025, this is the end of our fiscal year, which also coincide with the school years. And so as of the last valuation, August 31st, 2025, we have around 26 billion in assets. I'm rounding up. And we have around 25.5 billion in obligations or liabilities. So remember that I talk about the funded ratio, assets over liabilities. So you need to look at the actual asset value of 26 billion and the liabilities of 25.5, which then gives us the ratio of 102%. The actual asset value is slightly different than the market value. That's the asset smoothing I was talking about and not recognizing all the gains and losses all at once. Maybe you're interested to know that as a membership, the retirees are not exactly or less than 50% of the membership, but from a liability perspective, you all do represent more than 50% of the liabilities in the plan. Same table for the independent school. So the smaller plan, you can see the magnitude of the numbers. So 145 million instead of 25 billion. But the concepts are the same in terms of assets and liabilities to give a funded ratio. So with all of that, again, I know I'm talking to retired members and you no longer contribute to the plan, but I think what you want to hear is that the plan is in a strong funded position, that we are able to pay the benefits that you're receiving for your lifetime. But what also is interesting to know is that because we're in a good position, the contribution that are coming in the plan are adequate and sufficient, and therefore the active teachers won't see a change in their contribution level. So they're not going to be increased or decreased. They're at the right place and they're sufficient to fund the plan. So the active teachers continue to contribute. to pay the benefits that are being accrued for them. And the contributions are at the right level. So they were going to remain unchanged again for this year. But we did have a lot of contribution reduction in the last few years. Why? Because the plan funded was improving, the deficit was being paid, and therefore contribution could be reduced. But now we're in that good maintenance mode, stable and strong financial position. Again, because you're not contributing to the plan, I'm not going to spend too much time on it on this slide, but it just shows you the contribution rates that teachers are paying and the employers or government as a percentage of their salary. So as you can see, last year and going forward next year, they will continue to pay this to put the same amount of money in the plan as a saving. And for the teachers plan, the teachers, which is the green bar, is around 9.29% of their salary on average, and the employer is 8.92. Why is it slightly lower? I'm sure a lot of you remember the agreement of 1992, which says that there's a portion of the cost of living adjustment that is paid by the teachers entirely, that 10% additional cost of living adjustment or COLA is paid by the teachers. That's why the contributions are slightly higher. But the other part, so I'll talk more about the COLA later, but 60% of the COLA is jointly funded, and that additional 10%, which is to come up with a 70% COLA, is paid by the teachers. Trying to see the chat at the same time, because if you do have a question and you want to stop me because it's not clear, please do so. And that's just showing the historical contribution rate. Again, we're showing that to reinforce the message that the plan is in a strong financial position, and we came a long way from not being funded to being fully funded. And of course, as ATRF and our board, our main focus is to keep that really strong financial position and not go back to the time where there was a deficit and a green bar on that slide. I'm trying to go fast to give time for the other sections. So I don't see any questions. I'm really hoping that it gives you the information you need. It's really hard to see with no face. But please don't hesitate. We will plow through and we'll have time at the end. So with that, back to Rod on the investments.
Thank you, Julie. So I'll spend a few minutes now and I'll talk about our investments, and I'll get to our actual results for the past year in just a moment. But again, a couple of introductory slides or some higher level slides that kind of set the stage. When it comes to the investments at ATRF, what I want to talk about on this slide is I'm going to focus on the words in the very first bullet, ATRF's funding-driven approach. I want to talk about that because that is critical to how we choose to invest. We are a pension plan, as Julie said. We have liabilities. You saw the balance sheet. We have an objective of making sure that we meet all those future obligations, all those pension payments, decades into the future. So we are a long-term focused investor. Our horizon is decades. And our objective in setting an investment policy and deciding which asset classes, or what we would call our strategic asset allocation, and which I'll speak to on the next slide, we do that with the desire to make sure we are ensuring, or as close to as possible to ensuring, that this plan remains fully funded for the duration, for that long-term horizon. So look at the liabilities, look at what would change the value of the liabilities and what things impact our liabilities, and then design an investment portfolio that we believe best matches those liabilities and our ability to meet those liabilities going forward, regardless of what happens to those liabilities. So that's our focus when we're looking at investments. It's not just about seeking the highest possible maximum return. It's about managing the risks in the portfolio and designing an investment portfolio that will meet the objective of remaining fully funded for decades to come. That's what we do. The next slide just takes that down one more notch, and it talks about the actual how your pension plan is invested. And this is something that our board is responsible for. When I spoke earlier, I talked about the 90-10 rule. 90%, the board is responsible. The board of ATRF is responsible for setting this strategic asset allocation, and then providing that and as you can see on the chart on the right, those allocations to individual asset classes to AIMCO for AIMCO to then implement. What you see on the screen is our current strategic asset allocation. This is a result of work we did that took over 12 months of doing some robust analysis and looking at lots of scenarios and options for different allocations to all the different asset classes. Rigorous modeling that, thousands of scenarios of how the world might unfold going forward into the future. And then out of all of that, management and the board at ATRF selected the asset allocation that you see outlined on the chart on the right. We believe that is the best mix of assets that will stand the test of time and position our investment portfolio to meet our obligations going forward. That's the asset allocation. Now let's talk about the results for the past year. I'm very pleased to say that our investment returns for our fiscal year ended August 31st, 2025 was 7.53% for the portfolio. That's a good number, but it's even a better number coming from my perspective, because what's important is the number on the chart beside it, the 6.5, which we call on the chart the expected rates of return, or the expected rate of return for the year. And I'm going to refer back to what Julie said, the assumption. Why that number is so important is that is the assumption that we used going into the year that said, if that's what we need to earn in order to meet our future obligations and keep the plan fully funded, to achieve our funded status or better. And that is a long-term expected return. So we expect, as you saw, Julie talked about the assumptions that we use for doing actuarial work. In the very long term, we expect our investments to earn 6.5%. The fact that we did better than that and earned 7.5% is very good, because that just further strengthens the pension plan going forward as far as our ability to meet our future liabilities. Now, of course, I said we have a very long-term horizon. We look at those numbers over a number of periods, or those results over a number of periods. Over 4 years, we did not meet the long-term expected return. That is because that 4-year period still includes the end of the results from the coming out of COVID and the poor investment results that not only the teachers' pension plan had, but virtually every large pension plan and other institutional investor had because of the impacts of COVID. That will fall out actually out of the 4-year numbers after this year. But if you look further on, over 10 and 15 years, the pension plan has more than achieved the returns necessary to be fully funded and to meet our long-term expected return. So very, very good results. And I'll just drill down I think the next slide, I'll drill down into a little more detail about the results within the portfolio. The big story, of course, last year was what happened in the equity markets. So our returns were very much impacted by the strong equity markets, global equity, Canadian equities, and emerging markets. Those are all of the equities that we have in the public equity space. And 25% of our total portfolio is in publicly traded equities. So the strong market returns on a quarter of our portfolio certainly contributed a significant amount to our total plan results. There you can see a couple of other asset classes that did very well. The private equity asset class. So that's just like owning public equities, only we own equity privately through other large institutional investors that buy companies and keep them private. So it's the same type of investment, if you like. It still gives us the exposure to the ownership of companies like it does by owning publicly traded equities. It's just done in a different form, and it did not perform as well as public equities did last year. There's a few reasons for that. It is more subject to the impacts of interest rates, and that whole industry in private equity is still somewhat slow coming out of COVID, and there wasn't as much activity in that industry, and so there wasn't as many sales and purchases of companies. So that's a bit of and there's a bit of a lag. So we certainly expect that the private equity returns will pick up over time. We're not troubled by that. The other number that I will spend a minute on that you can't help but notice is the negative returns on real estate. And real estate does continue to struggle as an investment. That's not unique to ATRF. I want to at least leave you with the message that all our peers in the pension industry, all the Canadian pension plans, most large institutional investors are still seeing historically poor performance on their real estate investments. It continues to struggle. A large part of it, and especially in the office sector, of which we have a significant allocation, if you like, exposure to. The office sector continues to face headwinds, as they like to say, because vacancy rates in the office sector are still high coming out of COVID. That is definitely starting to turn around. Real estate also was impacted by the increase in interest rates over the past few years, because that higher interest rates goes directly to the formula used to come up with the valuation of real estate properties. So real estate continues to struggle. However, I just want to say I still believe that real estate is a very attractive investment in the very long term for an organization like a pension plan. Owning real property, owning office buildings, shopping malls, multifamily housing still has a lot of appeal to a long-term investor like a pension plan. So it did definitely drag down the returns for the year. But I'm still optimistic going forward. It's going to be a very solid investment in our portfolio. So there's the results for the year. And I think I can stop there. And again, as Julie said, if people have questions, I'd be very happy to answer them.
There are two, in fact, Rod. So before we go to the member services section, because we're definitely shifting gears in terms of topic, there are two questions that I think we could address now instead of the end. So one question is about, and I'm going to read it. Since we are overfunded by 2%, could the provincial government choose to stop paying into the fund to use up the 2% extra funds and then restart contributing when the fund returns to 100%? The answer to that question is no, they can't. We have a surplus agreement with the government and the ATA, the other sponsor, the Alberta Teachers Association. And it's a recent agreement in the sense that we were never in a surplus before, right? So we didn't have to deal with that. And there was a plan provision that would have looked a little bit like your question in the sense that as soon as there was a surplus, it would have been used to reduce contribution, which is not the best practice to do so. As I mentioned before, you need risk management levers. There is a notion that if you have surplus, you keep it, not forever, not if it's become too large, and there are some rules for that. But as soon as you declare $1 of surplus, you should not spend it right away. Again, it's like a saving account. You keep it for the rainy days, because if you need to spend it right away, your contribution will go down and up and down and up, which is not good. So the answer is no, they can't. The surplus is there as a risk management lever first, and we have a funding policy that provides guidance to our board and our stakeholders and our sponsors to say how could the surplus be used. But the first 10%-ish, I would say is usually a risk management lever. You're not starting to spend it when you're in that 10% range of surplus. Then, of course, you start looking at, okay, is it projected to increase? Is it going to start to be quite large? So from an intergenerational equity, it's also important to make sure that you're not creating too much of a surplus, the same way as you should not create too much of a deficit, because then it creates generational inequity that people paid but didn't necessarily get the benefit out of it. So we have a bit of time before we reach that threshold, if we do. And of course, we monitor the situation and then we say, okay, should we use the surplus now for something? Contribution reduction is one thing from both employer and employees, teachers. But there are other ways that surplus can be used as well to de-risk the plan or to redistribute it to the members and the government. So I hope that answers the question. And then the next one is, what do you predict will happen to our assets because of American tariffs? So I think I'm going to ask Rod to answer that.
Oh, I was looking forward to your answer, Julie. Well, no, it's a very good question. And of course, it's one that we are asking ourselves internally, very focused on. I would say I would go broader than that because I think it's fair to say we are kind of living in a very uncertain time right now on so many fronts. Tariff is the tariffs and what's happening because of the American tariffs is but one of many things that are happening in the world around us. And it's our job to be constantly thinking about what could these things mean to us as a investment, as an asset owner. But again, with keeping in mind that it's a long-term focus we have and not to be too overreactive to short-term phenomenons. And I'm not sure if the tariffs yet are going to be short-term or long-term. It's something that, as I said, we spend time thinking about. We spend time talking with our investment manager at AIMCO. It's not only on our minds, but we also spend time talking to peers at other pension plans and other organizations because, of course, it's top of mind with everybody. And what we are doing about it is, and working with our investment manager is, and it's again not about tariffs, but it's about the broader disruptors or the broader state of uncertainty that we're facing. And looking at our portfolio, looking at scenarios, looking at stress tests to make sure that we're thinking about what could these things mean to us as an investor, as a long-term investor, a long-term asset owner, and might that require us to make some shifts either in the short or the long term when it comes to things like that asset allocation that I talked about earlier. So it's not an easy question to answer, but it's a question that we're very live to and paying a lot of attention to, just like all of our peers.
Excellent. Well, there's no more question in the chat, so I will go to the next section, which is the member services. This is the other part of me. I'm like a mini wheat. I have two sides. So I have the funding side and I have the member services side. Don't ask me which one I prefer because I love them both. So member services, this is the heart of who we are and what we do. You are our clients, and we're here for you. I always say from hire to retire and after. So it's a pleasure to be there along your journey, and I'm hoping that we are meeting your needs. And of course, we always want to hear from you, and you'll see what we're doing to get your voice and your input from surveys. But it seems to be going well from what we're hearing. But of course, if there's anything, always reach out. So from a member services perspective, if you've been in touch with us, you know what we're doing, information, and of course, paying your pension every month, which is definitely, hopefully, meeting your needs. But information and tools and making sure that we have the information on file for you, for your beneficiaries, for your nominees. And we're just a phone call away, a website away, a member portal away for you to interact with us, transact with us. So who do we serve? of course, you, retired members, which are now representing almost 33,000. I'm sure now, by now we are. Those numbers are as of August 31st, 2025. So it's already a few months away. So let's say 33,000 retired members that are receiving a pension in the pension plan, representing 37% of our population. And it's a growing one. Definitely, this is where we see the growth. New retirees every year, and of course, a longer life expectancy, which is so great to see. And we have active members for sure, all very important, 44,000 of them. And the inactive category, 12,000. Those are members that still have money in the plan, might start their pension a bit later, might have moved province or moved profession, so have still benefits in the plan, but are not yet in payment. So for a total of almost 90,000 members. There's a lot of stats here. I love numbers, as I mentioned before, but I think you do too. I hear that people are curious about, the trends and the average, for example, average age of retirement. As you can see, 60 years old is still our average age of retirement at retirement. Very, very stable. I mean, it's been 15 years on that chart that we're in that range of 60 years old. And the average service at retirement is around that 25 years of service, which means that pensionable service, that they have service in the pension plan that is feeding their the pension. So 25 years of service, pensionable service, and 60 years old are the average. It's not a magic number, just want to mention. It's not because the average says it's 60 that you need to retire at 60. Retirement is a personal decision. And we have, a range of age from 55 to 71, because unfortunately 71 is the date that you have to start according to the income tax. But it's a very personal decision. There's no magic number. And please contact us. Well, now you're already retired, but if you know teachers are still active, they contact us and they see what kind of estimates and projection they would fit their own personal needs. And as a group, retirement member average age is the one that is increasing. Why? It's because we have older retirees living longer, and we can see that this number is on an increasing trend. So almost 74 years old on average, the retired members in the plan. A few more stats. Again, a lot of numbers. But this is the one at the top of the slides, the $1.4 billion. I'm always so proud and to see this is the benefits that we paid last fiscal year, to plan members overall. It includes the majority of retired members with their monthly pension like you, and a few, termination benefit or transfers to other plan. But the majority, it's around 1.2 billion, is monthly pension that we pay. So 100 million a month of pension is being paid to retirees from the teachers' pension plan. And most of those payments are made in Alberta, in the sense that most of our retirees, 85% of you, are still residing in Alberta. So this money is going through our economy here. And though the other majority is going to BC. So we have 108 employers in the plan. It is also somewhat of a growing number. When I started, we were, I think, 90 employers, and we've been growing. The majority of the growth is going from charter schools. New charter schools are being created, and they're joining the plan automatically. So just last year, there were 4 new charter schools joining the pension plan. So that creates new membership as well, which is good. The average pension here, that's the average pension in payment. So that includes all the retired members, not just the new one last year. Everyone combined is an average of 39,000, which is an increase of 2% from last year. And we have 55 members that are centenarians. That's quite impressive. 55 And Rod and I were talking yesterday, and now there's a notion of super centenarian. It's 110 years old. So we're not there yet because, as you can see, the oldest plan member for in the plan is 105 years old, which is quite impressive. But looking forward to our first super centenarian in the next 5 years. So this person has been receiving their pension for 47 years. So it's it's always impressive and so grateful to see those numbers. Here is just the what I mentioned before at the introduction of we want to hear from you. We want to make sure that we're meeting your needs, that we're offering the services that you need, the information, the communication, the tools. So we do surveys on a good cadence. We used to be doing them like every 2 years, but that was kind of too long of a lag. We want to hear from you more, but we also don't want to over survey and creating a bit of a fatigue because I don't know about you, but we have surveys on everything now, and every day, every moment that we do, someone wants to hear from us. So we are not surveying you every transaction. Um, the goal is to survey a portion of the members on a regular basis, but you as a member, you should receive a survey at most every 2 years. At least this one, the big one that we talk. We might do some event-driven survey. If you just retired, for example, we want to hear from you how it was, what we can do better, what works well. But it's an important source of information for us to continue to enhance and meet your needs. And I want to thank you if you were one of the respondents this round, because we do have a great participation rate when it comes to survey. Teachers seems to be, very engaged and very interested to provide input, and I so much appreciate. So we have a high participation rate, and I hope it's going to continue. I added this slide specifically for this group because I think you are interested to know your new fellow members that are coming to this group as retired members. So last year, in the last fiscal year, we had 1,069 new retirees that started their pension last year. And as you can see over the years, it's quite stable in that range of 1,000 per year, joining the rank of retired members. There's some peaks back in 2007, and we think there might be another one coming. It's usually related to collective negotiation and salary increases. So the other one that I've added is the life expectancy, which also is, I believe, of interest. Life expectancy, I just want to say this is based on, again, assumptions, averages. Doesn't mean that is the real number for all of you, but on average, based on the teachers, like our own teachers' own experience of mortality, the current life expectancy is 9 years old for a male teacher at age 65 and 92 years old for a female. It's quite impressive. We always say teachers have a longer life expectancy. I'm sure you've heard it before than the general Canadian population. Um, and and we're so happy that we can provide you a lifetime pension based on the funding of the plan, and that's what we use. And of course, we don't stop at 90. That's the beauty of a defined benefit plan. We continue to pay you after, and we are funding accordingly. But this is the assumption we're using on average. This number is increasing. If you look at it, what it was a few years ago, it keeps increasing with mortality improvement and medical advancements. I mentioned the 85% of members living in Alberta, and just tidbits, 33,000 retired members, and we're projecting to be at 40,000 by 2035, so in 10 years from now. Very quickly, in terms of what we're doing in our significant project, one of them is called Project Lantern. If you're not new to this presentation, you might have heard it before. It's a multi-year modernization project that we're doing to make sure that our systems, our process, our technology is resilient and stable and secure and be there for the many, many years to come, hopefully. It was time to do it. Like anything else, things age, and our systems were starting to show their age, and technology evolve, and we need to evolve too. So this is our modernization project. It's going well. It's a multi-year. We've started a few years back. We are starting to see the delivery of new tools and new systems. The picture that you see here was our launch of our new employer portal, T-Pro. So it's the Teacher Pension Reporting Online, and the acronym is T-Pro. So that's for the employer, the school boards. So as a member, you might not see it. So as long as you're receiving your pension, the data is reported. But this is one of the components that we've worked on. And of course, the next one is the member portal. This one you might see a little bit more of it. I'm hoping that you will see the improvement that we're making and evolution of the portal, our member portal. I'm hoping I cannot quiz you because your audio is turned off, but I was hoping to see raise hand of who's using our member portal. It's called My Pension. So that would have been my quiz question. So My Pension is our member portal. And this is where you can have access to tons of information as a retired member, to your statements, your tax slips. You can make transaction in terms of your personal information update, your preferences that you want in terms of communication. Do you want paper? Do you want digital? There's tons of good information in there, and I invite you to go if you haven't already. So, this slide, again, very, I believe, interesting for this group. As I mentioned before, we have a plan provision that is somewhat unique in the sense that it's not offered by all pension plans, but the teachers' plans do, and it's called cost of living adjustment, or COLA. Cost of living adjustment is what we call the indexation or adjustment for inflation, so that your pension is adjusted every year to account for that cost of living or part of it. And it's based on the plan provision. Because of course, when you retire, it's based on your salary at that point, your service at that point. But things change and cost of living evolves. So having that feature of adjustment to your pension every year is a good one to help limit the impact of the inflation on your source of income. So it's based on the plan provision, your pension is indexed or adjusted for inflation at 60% of the Alberta Consumer Price Index, ACPI, if for your service before 1992, and it's at 70% of the ACPI for after 1992. So you have the numbers here. I realize we say will increase because that slide was done before January 1st, but now we're after. It's already done. You should have received it in your pension payment in January. So you will see that number with the cost of living adjustment. So you will see that your gross pension increase by either 1.2, 1.4, or a combination of all of that. If you want to know your detailed calculation, because depending on your service, you will be between 1.2 and 1.4% increase, go on My Pension. There's a really nice breakdown of the calculation of COLA that applies to your specific pension. And I use the word gross pension on purpose this year. Why? It's because you might not have seen a net pension increase this year. And it's not because of the plan, it's because the Alberta tax rate have changed. So there's a little bit more tax, which kind of net out the increase in your pension. But if you want to know more about that, we have really good information on the website explaining the tax rate change. And remember, tax rate is not us deciding, it's the provincial government. And it's not because they've increased the tax rate in general. In fact, they decreased it last year, but they decreased it in a way that they went down a little bit further in July and then go back up in January. So overall, it's 8% for income less than 60,000. So it's 8% rate. That was last year as well, but they've started with 10, then 6. So that's 8% overall. And now we're back at 8. So overall for the year, you will see your pension income increase. It's just if you look from December to January, it feels like it didn't increase because of the tax. So I just want to mention it's even more important if you have questions this year because you would expect normally to see your pension go up. And it did on the gross side, but not on the net side. But overall for the year, your pension income should increase. So, speaking of tax and everything, very briefly, there's really good information out there that we send. Like I said, on the website, there's information not just about the tax thing, but everything about your pension. Your pension information statement. This is your annual statement that we send you in January before you receive your January payment so that you can see what to expect at the beginning of the year. It's available on My Pension, digital, but it's also mailed if it's your preference. So if your preference is paper, you are receiving it in the mail. And they're already emailed, so you should have received it by now, unless you live really, really far away. So pension information statement, really important to look at because, this is what we have on file for you. So if your spouse information, your beneficiary or anything else is not up to date, please let us know because that's what we use to pay you and to inform you. I think Rod mentioned at the beginning, our annual report is published today. So out of the press, it's going to be on our website. It will have most of the information. Well, we'll have the information we presented today and even more about our results, about the stats that I presented, our services. So please have a look. And then the member report, which is a kind of a summarized version of the annual report, will also be available shortly, both digital and paper, based on your preference. And I think that's it for me. Yes. Ooh, 157.
Okay, we have a couple of minutes left if there's any questions from any of the attendees. Oh, I don't see anything popping up on the screen at the moment. Oh, we've got one. Oh, no, just a thank you.
Well, thank you.
Well, thank you very much, Rod and Gilles, for presenting to us today. And thank you to the attendees for joining. We'll be sending out a survey following the session, and it will take less than 5 minutes to complete. We value your feedback as we plan for future pension and financial wellness seminars. This now concludes our webinar. Have a great day.